Everyone, I'm Russell Pillima, CEO of Pengana Capital Group. Welcome to the PE1 webinar. Thank you for taking the time to be with us today. Joining us on the call are three of my colleagues from GCM Grosvenor. Firstly, Fred Pollock. Fred is GCM's Chief Investment Officer and is also the designated portfolio manager for PE1 and a member of the PE1 Investment Committee. Secondly, Brian Sullivan. Brian is head of GCM's private equity secondary practice and also a member of the PE1 Investment Committee. And finally, Corey Lepretti. Corey leads GCM's private equity portfolio management team and works closely with Fred on the construction and management of the PE1 portfolio. As you all know, it's been an extremely interesting 6 months in investment markets with ups and downs that probably nobody ever would have predicted. Over this period, the net asset value of PE1 has been relatively stable, with a modest amount of volatility being driven by the fluctuating AUD-USD exchange rate. So on the surface of it, it might appear that not much has changed for PE1, but this is definitely not the case. There have been significant positive developments, which Fred and the team will elaborate on today. The formal presentation will take approximately 40 minutes, after which there will be time to answer your questions. My colleague Adam Myers, Head of Distribution at Pengana Capital Group, will take charge of the Q&A session. Please submit any questions that you have via the icon on the bottom of the screen. I hope you will find the session to be insightful and valuable, as well as giving you a good excuse to switch off CNN or Fox News for a while and take your mind off the US election. Fred, over to you.
Thank you, Russ. I'm going to use a few of the slides, starting on slide 4 in the deck, just to give you a bit of background for those of you who are joining for the first time or getting to know the PE1 story. On slide 4, you'll find an overview of Grosvenor. So Grosvenor is a 50-year-old alternative asset manager managing about $57 billion worth of assets across the entire private equity spectrum. So we concentrate on private equity primaries, secondaries, and co-investments. Also opportunistic investments. We have a 162-person investment team that tends to all of those different activities, and all of their work feeds into the trust in one way or another in terms of our investment activity. In terms of the portfolio itself, if you go to slide 5, the principal investments are private equity investments. Our team in private equity is more than 20 years old. We focus on the middle market buyout space, and I'll talk in a second about the advantages we see in the middle market space. We believe that our global team with offices in the US, Europe, and Asia puts us in a good place to participate in all the key markets for private equity investments. And we think that our verticals organized by primary, secondaries, co-investments, and direct investments make sure that we cover the entire investment landscape in the right way. We have more than 400 manager relationships, which you would see on the right part of this slide. It's a very important number. We think the depth and breadth of our relationships are really the key to differentiate us in the broader landscape. There are not many managers in the world with $20 billion plus US of assets under management targeting this space and the incumbent relationships associated with them that really serve to enable us to get into the stream of private equity, which is what we deliver in the PE1 solution. If you look at slide 6, I alluded to this a second ago, just to remind folks about kind of our larger concentrations. At GCM Grosvenor, one of our real areas of specialization are small and mid-sized firms and funds. We believe that this area outperforms the larger end of the market, meaning kind of the mega cap buyout funds and funds targeting $5 and $10 billion deals. Typically, these funds are $500 million to sort of $2 billion in size. If you look on the slides, they're a little bit busy, but I think what you'll see is that in all periods of time, whether you're talking about over kind of a 20-year span, before the financial crisis in 2008 and 2009, and after it, in all those periods in time, this small and middle market space, because it is more inefficient and because there's more opportunity, there's a tendency for the returns to of returns available in the top quartile of management to be in excess of those broadly available in the private equity space. And that's with private equity returns themselves being highly attractive. And so we think this is additive to that, that investment solution. If we go on to slide 8, I want to talk a little bit about the state of the market today. So make this topical, and then I'm going to turn it over to Corey to talk about the portfolio in more detail. And then Brian Sullivan's going to go through a very detailed review of our secondaries practice as a module to sort of educate about one of the key components of what we do. The state of the private equity market's really interesting. So, we're cautious about valuations. We were cautious about valuations pre-COVID, and we're cautious about valuations post-COVID. The liquidity in the marketplace, interest rates, all of those factors are obviously causing investors to value future cash flows at a relatively high rate. That has not prevented us in any way from investing quite deliberately over the last 3 to 5 years, maintaining the rates of return that we've seen historically in the practice. What it has required, though, is us to be very, very selective. And so one of the things we would talk about constantly in our practice is that we pretty much see everything. We have an opportunity to invest in most of what is available in private equity, and we're very selective about how we engage in it because of that cautious view about the marketplace. COVID-19 really caused a lot of interesting effects. The first, it created opportunity in March and April and May. We were able to deploy capital into that from behalf of the trust, particularly through the multi-asset class fund and some of the co-investment fund. And Corey will talk about that, some of the investments. The other is it changed market dynamics in some interesting ways. So I think our house view is that the interest rates will be lower for longer. I think that's a consensus view across the marketplace. Which means that we're planning for an environment that should be fruitful for the judicious deployment of capital over the next couple of years. And so I think people would have said we were late cycle a year or two ago, and I think that cycle probably was extended pretty significantly by these events. And it provides us an opportunity to deploy capital on behalf of the trust and sort of enjoy those returns. We do look for volatility and dislocations in the market to accelerate our capital deployment, but if you looked at the overall plan for the trust, which Corey's going to review, it really is methodical the way we think about deployment, both diversifying by asset type, region, and by time. And so we're not counting on any sort of dislocation to deploy the capital judiciously. At the bottom of this slide, one thing you'll notice, and I think this is true in all environments, particularly true in volatile environments, we really do concentrate on cycle-tested managers and working with them in all contexts. So whether that's investing in a primary fund, whether that's doing a secondary transaction, whether that's making a co-investment, the underwriting and determining how well the stewards of that capital in terms of sponsorship handle themselves through difficult environments is extremely important to us. And so I think that's only become more important in 2020 with the volatility that we've seen in the marketplace. On slide 9, a little bit of an outlook for the primary markets. Here, I think if you look at the opportunities in the second column, I think is probably where I want to focus mostly. Healthcare and technology are really thematic areas. We're seeing a lot of tailwinds caused by the pandemic. So the acceleration of existing secular trends is a theme you'll hear us talk about tonight in your morning. And the reasons for that I think are obvious, which is those secular trends were in place before COVID, and COVID has really forced people to focus on them and accelerate those trends, pulling forward a lot of changes that were going to happen over the next 5 or 10 years. And there's some examples of that in the portfolio that we can talk about. The other thing that I think is very, very important is the drive that you'll see in our portfolio and the opportunity presented by the ability to restructure businesses, participate in an active way and generate real value through the management of the businesses. We think this environment actually is added to that inventory of potential opportunities. So there's a lot of balance sheets that are not quite right, and they wouldn't be right pre-COVID, but they're really not right post-COVID, given the stresses you've seen. And there's a lot of under-optimized businesses available for improved management, which really is at the core of what private equity is trying to do and deliver for the ultimate investors. I'm going to pause there. We're going to take questions at the end, and I want to leave time for that, and given what we're going to review. And I want to make sure that Corey has time to go through the portfolio in more detail, and then Brian has a chance to really talk about the secondaries practice. And then we come back. I'm sure one of the questions which we were talking a little bit earlier, and Russ previewed, was people are going to want to talk about the election. So we'll save that for the Q&A. I will give you advance notice. None of us actually know who's won the election yet, but we're going to be happy to talk about it in the questions. So Corey, maybe if you could start on slide 12 and dive into the portfolio a little bit in more detail.
Thanks very much, Fred, and thank you all for joining us this morning. So if we start on slide 12, I'll begin with just a quick reminder of PE1 strategy. Here you can see our target allocations for the long-term portfolio by strategy, with the portfolio being split relatively evenly between PE co-investments, primaries, secondaries, and opportunistic investments, which, as Fred mentioned, is our multi-asset class solution. We have established target ranges rather than specific targets, as this will be a very dynamic portfolio that will shift over time as investments are realized and capital is redeployed to new opportunities. I do think it's particularly important to note the level of diversification we are creating here. Once we reach the long-term target portfolio, which that was targeted to be 3 to 4 years after the IPO, investors will have exposure to over 90 funds and over 500 companies, so no single fund or company will move the needle. Really, in creating this portfolio, we aren't looking to swing for the fences and take on the potential for big downside risk in order to chase a huge outperformer. Rather, we are looking for middle of the fairway, consistent, reliable performers, and we can accomplish that by investing with or alongside the best of breed managers we invest with on behalf of all of our clients. And to that end, the target return is 8 to 14%, but I think it's really worth noting that this includes the ramp-up period as we're deploying capital, and that we believe the portfolio will comfortably be at the higher end of the range once we hit the steady state after year 4. Moving to slide 13 really quickly before I get into the components of the actual portfolio. This slide illustrates how the portfolio is doing from both a committed and an invested perspective. 68% of PE1's private market portfolio has been committed across PE co-investments, primary, secondaries, and opportunistic investments. And of that amount, 53% has been actually invested or funded. The slide illustrates one of the common dynamics of investing in private equity. It takes time to get money in the ground, particularly if you're seeking a prudent level of diversification across sponsors, vintage years, geography, sectors, and strategies. We do expect this funded amount to ramp up over the course of the next 6 months, as both our opportunistic and co-investment sleeves are or will be substantially invested by the end of 2020. And the PE primary fund managers we have invested with have begun to identify and execute on attractive opportunities they are finding as a result of the current environment. These numbers also reflect the raise that PE1 completed in July. Before the raise, PE1 was actually 100% committed to investments across our various sleeves. Now, turning to slide 14, where you'll see the current portfolio allocations. It has now been 18 months since the launch of PE1, and as you can see, we're already well diversified, having committed $201 million to a broad mix of PE primaries, co-investment secondaries, and opportunistic investments. As I noted earlier, we are about 68% committed to date, and we expect to commit the substantial majority of the secondary raise from July into secondary transactions. My colleague Brian Sullivan will talk about the secondary opportunity in detail a little later in the webinar. Within our PE primary sleeve, we have made commitments of $59 million to 9 private equity funds, which includes 8 highly oversubscribed, difficult to access middle market buyout funds, and 1 brand name special situations fund, a Carlyle credit fund that's focused on privately negotiated credit solutions. Within the allocation, we have generally targeted disciplined sector specialists that possess unique sourcing and operational capabilities. We're really trying to drive value and have demonstrated these capabilities over multiple market cycles, as these types of managers have proven to be the most successful no matter where in the market cycle we are. The managers we have committed to, they've experienced severe market downturns before, they've successfully navigated through them, driving value in their companies, while at the same time taking advantage of new opportunities as they presented themselves. We believe the managers are particularly well positioned to take advantage of new opportunities. They have about 80% of their capital still to deploy to new investments. And as Fred noted, we believe there will be ample opportunities in the current environment to purchase under-optimized businesses that lack the leadership or the liquidity to weather a continued downturn. PE1's allocation to co-investments is being executed through a commitment to our co-investment fund, GCF2. GCF2 targets co-investments alongside high-quality middle market buyout managers, sticking with our theme on the middle market, looking at companies that have established revenue models, preferably in defensive sectors such as healthcare, technology, and consumer staples. To date, GCF2 has committed over $600 million to 19 companies, and nearly $460 million of those commitments have been invested. 2 of these investments, which are subject to some regulatory approval, which we expect to receive soon, are expected to close in early December. And once they do, the fund will be approximately 80% committed. We would expect to make another 3 to 4 investments to close out the GCF portfolio early next year. Portfolio is very well diversified by industry, geography, vintage year, sponsor, and it actually includes 8 new investments made this year, including 4 in the second half of the year when we felt valuations had come around a bit. And with regards to the existing portfolio, we still think it's important to note we do not view any of these investments at potentially high risk due to the impact of the pandemic. Really, we believe this is due in large part to the more defensive nature our co-investments have taken in recent years. Secondaries, that's the one sleeve of the portfolio where we're a bit behind on our initial investment plan. To date, we've completed one secondary transaction, purchasing interest in 4 funds managed by a firm called Alpine Investors. Purchased that on the secondary market back in February. But we do believe that PE1 will ultimately benefit from the disciplined deployment approach that we have put in place. And once again, since Brian is on and we'll be walking you through our secondary strategy and the opportunity in detail shortly, I won't go into any more detail on that now. Finally, PE1's opportunistic allocation is currently being executed through a commitment to MAC2. As a reminder, MAC2 has the flexibility to invest across our entire alternatives platform, basically opportunistically choosing the best deals from whatever sourcing channel they come from. Effectively, think of it as an over-allocation strategy that overlays the entire Grosvenor platform. MAC2 has been very active since March, deploying more than 50% of its total commitments into attractive opportunities that have presented themselves since the crisis began, including in many companies that have been positively impacted by the work-from-home orders put in place as a result of COVID. These include companies like Instacart, which we've talked about on a number of these webinars and on our reports because it has done so well. Wix.com, which is a company that produces software that allows small businesses to build their own websites without needing to add a code, as well as Unity Software and Lineage Logistics, which I'll talk about more shortly as I go through the recent developments. Moving to slide 15, so I can talk about a few of the things that have gone on most recently. Within our PE primaries portion of the portfolio, we are now really beginning to see a ramp up in investment activity following a very disciplined approach by sponsors during the downturn, with several of the primary funds making their first or second platform investments in Q3. For example, Veritas was one of our earliest investments actually in PE1 in Q3 last year. They just completed their first investment, the transaction where they financed the carve out of a U.S. state and local health and human services business from a New York Stock Exchange listed parent, DXC Technologies. The investment is squarely in Veritas' wheelhouse, the company that provides critical services to the government in the healthcare space, which is part of Veritas' target strategy they've effectively executed on for many, many years. We also just completed our 9th PE primary investment, committing $7 million to a fund called Waterland Private Equity 8. Waterland pursues a buy and build strategy across Western Europe, really seeking to drive returns by applying its experience and core value drivers to achieve operational financial value creation. They focus on 4 main themes: aging population, leisure and luxury, outsourcing and digitization, and sustainability, as they believe those sectors are most conducive to their strategy. Basically, the growing number of elderly in the population, a preference for luxury and convenience, an emphasis on efficiency improvement and outsourcing non-core business, and the awareness of the environment and sustainability all form the foundation behind their investment thesis. With respect to our co-investments, as I noted before, GCF2 has been quite active since July 1st, committing over $175 million to new deals. One of these deals is in a company called Uber Freight, which is related to its parent company, Uber Technologies. And they're a digital freight broker and an innovator in the large and very fragmented U.S. truck brokerage market. The company brings proprietary IP to a historically manual brokerage process of matching shipper loads to carrier capacity, ultimately with the goal of lowering operating costs, reducing empty miles for carriers, and providing better price transparency in the market. Finally, on GCF2, it's worth noting that GCF2's marks have rebounded quite nicely since the onset of COVID, and they are expected to have returned to close to their pre-COVID levels once Q3 marks are finalized later this quarter. Turning to our opportunistic sleeve, there are 2 deals we want to highlight. One is Lineage Logistics, a global warehouse and logistics company specializing in cold storage, which has benefited from the increased volume in the grocery supply chain due to the stay-at-home restrictions. Lineage, top 10 position in the fund in terms of size. They recently finalized a new financing round at a material increase in price to our current mark. The valuation increase will be reflected in our Q3 marks. And the last one I thought it was worth highlighting is a company called Unity Software, which is the developer of software used to design video games. Not surprisingly, this has done quite well during the COVID lockdown. Unity announced in early September that it would be going public, issuing stock at a target US $52 per share. They actually debuted on the New York Stock Exchange in mid-September at $75 per share, and they were trading at over $105 per share at the end of normal trading hours today in the US. So those are a few recent developments in the portfolio. Happy to take some questions on it at the end. I'll now turn it over to Brian to really dive into our secondaries practice.
Hi, thank you, Corey. So Brian Sullivan here. I head Grosvenor secondary activities, as was mentioned. I've been investing in the secondary market for over 2 decades, and I sit in Grosvenor's New York office. As Corey mentioned, I want to talk about Grosvenor's secondary capabilities as well as a bit about what's going on in the market. Before I do that, just a bit of commentary on what a secondary transaction is as a review. So secondaries are providing liquidity for institutional investors, typically in private market funds. So we acquire interests in private market funds from existing limited partners. And as I'm describing, you can understand, because these are private funds and within them private companies, it's all about information access and relationships that can give you that access. And as shown on this slide, Grosvenor has a fantastic platform from which to do that. Earlier, Fred mentioned that the 20 billion in AUM in the private markets, close to 60 billion in total across some of our absolute return strategies as well. A really experienced team and a lot of resources dedicated to secondary market investing, and what I'll describe further, what I think is we have a really, really interesting strategy. Next slide. So right now it's a really interesting time in the market, and Grosvenor's strategy is really, really well positioned. We believe there's going to be a fantastic secondary opportunity coming over the next few years, largely driven by what's been somewhat driven by what's been happening because of the pandemic and some of the kind of mispricing of assets that come as a result of that. We break the market up into 2 different categories. We use the terminology traditional LP, traditional limited partner deals, and GP-led opportunities, general partner-led situations, and I'll describe them in more depth in the next few slides. Next, please. So a bit about Grosvenor's secondary strategy. Our strategy is built around 3 core elements. We have a really differentiated primary investing portfolio in hard to access and thinly covered managers. Our portfolio looks very, very different from other players that participate in the secondary market. So that means the information we have, the relationships we have, provides us unique access to secondary deals involving our funds. In addition, we target the lower end of the secondary market. Generally, our transactions are less than 50 million in size. Our average deal size over the last few years has been around 20 million, and we often buy our assets at a discount. When you look across the deals we've done over the last few years, it's around a 16% discount to the reported value by the underlying managers. A bit more about the extent of our relationships. So we have investments in over 800 private market funds. When we invest in those funds, we're often on the advisory board of those funds. And as an advisory board seat, you're typically asked to opine on the underlying valuations of the companies, which gives you detailed access to information about those about the underlying companies. In addition, because the funds we invest in on a primary basis tend to be smaller funds, that often means the managers are a lot more involved in the secondary processes. You know, not only do they often restrict the fund transfer to existing investors in the fund, they're also very careful about what type of information they disclose and who they disclose it to. And that's really important in a private equity world where the quarterly reports come out 3 to 6 months after the fact, and those quarterly reports often have, you know, sometimes stale information on the underlying companies. So if you're a secondary buyer and can get real-time access to information with often forward-looking insights about what's going on in the portfolio, that's absolutely critical to underwriting a secondary transaction. Next page. A bit about the team. I won't go through all the names here, but suffice it to say, we have a lot of resources dedicated to secondary activities on a global basis. Not only do we have a deep team that does nothing but secondaries, we have offices around the globe that help with sourcing and diligencing transactions. I will note some of the numbers on the left-hand side of this slide. We have a whole team that focuses on operational due diligence on private equity funds. So before we even acquire an interest in a fund, you would think it would go without saying, but we do a whole, not only investment level review of the portfolio, but also an operational review of the manager and the manager's process. In addition, we have a really deep team of finance, legal, and accounting and technology, all of which go to support our secondary activities, amongst other things. Next page. So a bit about how we construct portfolios for our clients. And a lot of the statistics here are built around our primary investing capabilities. We want to invest in the secondary market where we have the greatest information and the strongest relationships on the primary side, because that's what's going to give us an advantage. So geographically, our focus is mostly in the US, with a bit in Europe and a bit rest of the world. On the top right, mostly buying interests in middle market buyout funds, but Grosvenor does have a diversified portfolio of fund investing, including special situations, some real assets, and large cap funds. But most of our investing activity on the secondary is going to be targeting on the middle market. On the bottom right, you can see we're focusing our activities in situations where we've already invested with the underlying manager. That is the greatest source of our information and relationships. However, it's not the only source. We routinely come across transactions that, just given the nature of our over 160 investment professionals, there's some connectivity on a deal that gives us an advantage. And then on the bottom left, most of what we do is going to focus on traditional limited partnership acquisitions. So we're buying a single interest in one fund at a time or a portfolio of funds. General partner-led deals are unique because rather than an acquisition where you're buying from a single seller, general partner-led opportunities are situations where the general partner of the fund or the fund sponsor is coordinating liquidity on behalf of multiple investors in the fund. And that's an increasingly important part of the market, because as funds are coming to their end of lives, or sponsors are trying to create liquidity for their investors, but at the same time holding on to their best assets, they're coordinating these secondary activities where they're bringing in new investors, providing the existing investors with liquidity, but allowing the sponsor to continue to run, with their best quality assets for a longer period. Next slide, please. So a bit about what's going on in the market. This slide shows the trajectory of the secondary deal volume over a long period. And you can see on the right side, 2020, the secondary market slowed down pretty materially. That was entirely expected. And as you can see on the left hand, the 2008 to 2010 period, the same thing happened around the global financial crisis. And the dynamic that leads to that is private market assets take longer to adjust their valuations than public market assets. That creates as a result of that, secondary buyers want large discounts on their purchases, even larger than normal. That creates a point of friction, and the market slows down for a period. Now, we're already seeing an increase in activity in the back half of this year as the public markets have adjusted, and secondary buyers and private equity portfolio managers have a better sense for how the pandemic is impacting the individual companies and the portfolios. I will note that the dark blue bars in the top have shown the growth of these GP-led deals over the last number of years. As you can see, the general partner-led deals or the sponsor-led deals have been an increasingly substantial part of the secondary market. And in the first part of 2020, they accounted for almost 50% of the market volume. We think that trend is going to continue and accelerate and really create fantastic secondary buying opportunities, particularly for fund managers like Grosvenor that have the good relationships with these sponsors and can get access to very hard to access and potentially oversubscribed situations. Next slide, please. Now, there's of course a really great dynamic around the pandemic that's going to result in a growth in secondary deal flow. However, you can't ignore just the natural growth of the secondary market. Now, people speak about the growth in the secondary market as being driven by, just it's becoming in a more accepted terminology. There's no longer a stigma about selling. There's lower friction costs in the form of lower discounts and lower banker fees. What gets lost in all of that is just the growth of unrealized value that is sitting in older private equity funds. And what's shown on this slide in the light blue is the amount of unrealized value that sits in private equity funds that were greater than 10 years old at the time. And you can see over the last 4 or 5 years that value has grown substantially. And we use the 10-year point because that's typically when an investor will more naturally look to sell their interest on the secondary market. It's a time when a general partner or sponsor will more naturally look at liquidity alternatives on behalf of their investors, maybe without selling the underlying companies. So what we wanted to do is project the potential growth of the secondary market in the future. And frankly, it's easier than you would think to do that, because all you need to do is look at the amount of capital that was raised by private equity funds 10 years earlier and the typical trajectory of unrealized value within a private equity fund. When you combine those two data sets, you'll see that the potential growth in unrealized value in private equity funds is going to grow substantially over the next few years. We believe that's going to be a material driver of secondary opportunities. Next, please. Just to provide a finer point, go from theory to practice on the type of deals and our unique positioning. Here are 3 case studies. I'll talk to 2 of them. The first is Project Rocket. And you can see it's around a $30 million transaction size. We acquired an interest at close to a 20% discount. The dynamics here was a corporate seller was selling a portfolio of private equity funds. The overall portfolio was more than 500 million. We leveraged our relationship with one of the underlying sponsors. In that case, working with the sponsor agreed to restrict the process, restrict the buyer universe to only existing investors in the fund. We were the only natural secondary buyer within the fund. Most of the others were foundations and endowments, people that weren't experienced in secondary transactions. So we got a really unique perspective on the portfolio and great positioning in the process, such that we were able to acquire our interest at close to a 20% discount, whereas the other interests in the transaction were sold at prices, in single-digit discounts. And in addition to the really great pricing, it's a fantastic diversified portfolio of mid-market assets in the U.S. I'll note it was a 2016 vintage fund, so they were seasoned assets, and most of the portfolio, most of the capital in the fund had already been invested. The second opportunity, similar transaction size, you'll see similar pricing, around a 17% discount. This deal was unique in that the seller only wanted to sell this individual an interest. It was the last private equity position held by a financial institution. It was held in a part of the financial institution that nobody was paying attention to, so they never got around to selling it. At one point, a controller woke up and said, "Hey, what are we doing with this? We should seek liquidity." They reached out to the sponsor. The sponsor said, "We'll be happy to work with you. Grosvenor is one of the largest investors in the fund. They're on the advisory board. You should speak to them about the transaction." So working with the sponsor and the counterparty, we were able to execute this deal in a relatively expeditious fashion. This was a 2007 vintage fund, so we actually acquired it in 10 years, in year 10 of its life, And at that point, we had really good visibility to what was going to happen in the portfolio. And in fact, we had really good insights into one of the companies being sold in the near term. That happened at a level well in excess of not only the fund's carrying value, but our purchase price. So again, just give you a sense of how the type of deals we do and some of our unique sourcing and relationship advantages. Next slide. And finally, a bit about what we've been seeing over the last couple of years. We're really selective in the type of secondary transactions we pursue. Our first screen when evaluating a deal is, do we have some form of information or relationship advantage? We close on less than 1% of the deals we source. We believe we see most of what happens in the secondary market. We evaluated over $100 billion of secondary opportunities over the 2-year period ending December 19. And we close on less than 10% of the proposals we submit to the seller. And more often than not, when we don't get a deal done, not because it goes to a competitor, but because the counterparty decides not to transact at our price and instead hold the asset. So we think we're really well positioned there. On the right-hand side, you see the volume of deals we've sourced over the last few years. You can see that the volume we're sourcing is has increased every year. That is in line with what's been happening in the growth of the secondary market. 2020, which the first part of the year isn't shown here, there was softness in transaction volume, but that's increased substantially since early September. Thank you very much. We, again, in summary, I think we have a great platform from which to execute secondaries and a really unique strategy.
Thanks, everyone. I think that was a very useful portfolio update. As expected, US politics has certainly dominated the Q&A. And looking through, I think we've got at least half a dozen questions about the elections. I'm not obviously going to ask them all. And I think we can capture a lot of what has been asked with sort of the following question, which Fred, I'll direct to you. From an investment perspective, are there things that you will be doing differently under a Biden presidency that you would not have done under a Trump presidency, assuming the betting markets are correct and it is looking like a Biden victory at the moment? Or is it just a case that good companies are good companies regardless of the political environment? And while you are answering that question, perhaps you can also consider the scenario when we have a gridlocked environment if the Republicans continue to control the Senate. Thanks.
Okay. I'll try and unpack it. So the first thing I'll say, nobody at Grosvenor is capable of forecasting the elections, but we can read all the same data you're all reading. So right now, there's sort of an 80 or 90% probability that you'll end up with President Biden and a Republican Senate. And so I'll work off of that one and let's assume that that's the case, and I'll go through some of the scenarios if that turns out to be wrong. What does it really mean in terms of what do we think it means for policy, and therefore what do we think it means for our own activities in the portfolio as a whole? I think the most important thing that would mean is you're going to have relatively stable tax policy in the United States, which was a big variable in this election. So one of the proposals from the Biden's candidacy was to alter capital gains taxes for the wealthy in the United States and make capital gains taxes the same as ordinary income taxes, which would have, at least in our minds, stimulated a significant amount of deal flow going into the end of the year, right? And also meant some structuring around that, meaning it could have accelerated deal flow into the end of this year and then probably slowed deal flow down a lot next year and thereafter it genuinely changed. We don't envision that happening if you had the scenario that I just described. And so I think we would see a normal deal flow environment. I think the other, you'll see less kind of fiscal stimulus and you'll see more central bank intervention. So you have rates lower for longer and you'll see kind of less deficit spending. Doesn't directly hit a lot of our portfolio companies, but I think the more important thing actually is that in that gridlocked environment that you've described, you'd see many more executive actions from the Biden administration, because that'll be the thing that they can do. And those executive actions are not, they will cause significant winners and losers in the marketplace. And it's important to understand that, right? So the energy sector would be a loser. Not writ large, not everywhere, but net, you would argue that that would be something where actions can be taken and policy actions are likely to be taken, but probably not as much as if you had a blue wave in the United States and you had legislative action. So it's sort of negative, but not as negative as it might have otherwise been. Those types of sector theses, obviously, we're still, we'll go through as we look and try and understand who's won which elections. In fact, it matters which senators won what elections. And we'll go through and try and understand how that will have implications for our portfolio. I think writ large, it's really a status quo type outcome. So the idea that you have gridlock, we had gridlock largely before. I mean, we didn't, one party rule. Donald Trump was as a president is a little bit of a political creature unto himself, right? Not completely aligned at all times with his own party. And so far was a little different. I think if you had had the blue wave and you had all Democratic control, you would have seen a very aligned political set of actions, and you could have seen significant movement. This we view as more of a status quo. And so for largely what we'll do is just continue on doing what we're doing. Same tax policy, same types of investments. I do think it'll favor certain sectors. The sectors, healthcare and technology, as we mentioned earlier, I think would continue to be favored sectors because the response to COVID is more likely to be conservative rather than aggressive in terms of lockdowns and other types of responses. And so those secular forces are likely to continue. So on the margin, we'll be looking at that. But largely what we do as a business, we find great sponsors who know what they're doing, are investing over a 5 or 10 year period to generate real multiples on their capital and figure out how to participate in their flow in those great companies. That's not going to change. We would have done that regardless of what combination won. So if we're wrong and it turns out that President Trump retains the White House or the Senate goes to the Democrats, it's not going to fundamentally alter what we do.
Great, thank you. Moving on to more investment related questions now. First question for Russ. Earlier on this year, PE1 was trading at a very rich premium. We haven't seen this premium since you raised capital in July. In fact, over the last month, we've actually seen a slight discount. What do you read into that, and how do you plan to manage it?
Yeah, thanks for that. Look, I think that we've always said that we would hope that PE1 does trade at a premium, that we think it is a premium type product and that it justifies trading at a premium. All that being said, we don't want things to get out of hand and a premium to be too large, at least not in the short term. We think that to build this up slowly and steadily over time is the right way to go, and for the underlying portfolio to justify where that premium is at. Some of the very large premiums we saw earlier on, some of investors found that unhelpful, and that it's hard to get clients set into portfolios when you're trading at such large amounts. And then what happens is the markets dry up and the liquidity disappears, etc., which is not good longer term. So how do we? It is slightly depressed at the moment. It's trading at a couple of cents a discount at the moment. As I said, we would hope that we improve that over time. The way we improve it is just doing what we're doing in the portfolio, Grosvenor making great investments, and then communicating with the market and making sure the market understands what's in the portfolio and can see the results. And so what hopefully we'll see as the portfolio gets more and more invested over the coming months, additional information comes out, some great success stories, which I think Fred touched on and Corey touched on earlier on. And we think a combination of the investments plus the communications will help pull us to a premium, and over time, hopefully that's a nicely increasing premium.
Thanks, Russ. Fred, another question relating to the capital raise. We have seen a very strong recovery in listed equities since the March lows, which obviously means less opportunities for valuation-aware investors in listed markets. When we were raising capital in June, we spoke about a very rich opportunity set, but are there also fewer opportunities than expected in the unlisted environment?
It's a good question, and I think the answer is no. And the reason the answer is no, particularly if you looked at the capital deployment of the trust, the area that Brian Sullivan ran through, which is our secondaries practice, is really the primary area that we want to deploy capital and really have a little bit of catch up to do in terms of deployment of capital. That environment, I think, is really richer than ever, and it continues to be very fruitful. And all of the market dynamics are really setting up to create a little bit of a supply and demand imbalance that I think will be very favorable for the deployment of capital in that particular space, over the next year or two. I think the other thing I would say, there's a decent amount of distress and stress below the headline in the indices. So if you looked at the global indices, half of all of the market is still down on the year. So the indices look okay, and they look like they recovered a lot, but there is a kind of a large cap tech effect in a lot of these indices, and there's a large cap company effect that I think makes them a little bit misleading indicators about how your average business is doing. And a lot of what we do, particularly in the middle market private equity space, is concentrate on real businesses that are connected to the real economy and of a size where there is a little bit of fragility at times, meaning this is not Amazon that just sort of everybody's locked in their house and they order more things. These are companies that have customers, they have plans, revenue might have been affected, there's stress. Because we're really in the deployment phase of the PE1 trust, that those events, while tragic for most human beings, and we don't like to see them, are actually quite favorable for us deploying capital. And so I think the environment got very rich, and it stayed really rich. And it'll take several years for us to work through that in the illiquid space.
Great, thank you. Corey, can you tell us more about the committed capital, the types of investments we have committed to, and when we should expect to see more of this capital drawn down? Corey, you're on mute.
Apologies. Thank you for that. Certainly, and I alluded to it a little bit before. We've actually been tremendously active in our opportunistic sleeve since the beginning of COVID. There's some recycling available in that portfolio. We've actually committed 100% of that portfolio, and some money has come back and is being recycled for new investments. Within our co-investment sleeve, while it looks today to be only about 50 to 60% drawn, there are two other investments that I alluded to earlier today that are expected to close later this year, which would draw down another 10 to 15% of that portfolio to get that up to about 80% funded by the end of the year. And we would expect to deploy capital into early next year. I think where you're going to start to see the real ramp ups is certainly in the PE primaries portion of the portfolio. A lot of our managers, as COVID hit, were focused on their existing portfolios and trying to wait for valuations to normalize before they started to deploy capital again. There were a couple of investments before, but there was very little activity over the summer as they tried to maintain discipline and not buy overvalued assets while the marks continued to normalize. Now we have just started to see in the last, I'd say 2 months, about a significant more activity within the portfolio. Coming into August, about 10% of the primaries portfolio was drawn down. Another 10% has been drawn down, and that includes us investing in a new fund just a couple weeks ago. So we would expect to see a true ramp up in activity by those funds as they continue to see opportunities. We also would expect and hope, given the opportunity that Brian talked about in the secondaries market, to be able to really begin to execute on some secondary opportunities where we'll have the opportunity to deploy capital a lot more quickly than you do with primaries, which are drawn down over time.
Great, thank you, Corey. Brian, a couple of questions for you. We have heard that you're typically able to acquire secondaries at a discount. and that you often have a seat at the advisory board that gives you additional insight into valuations. But in this environment, how certain can you be about those valuations?
Yeah, you're always skeptical about valuations, but we believe the best situation is where you're getting real-time access to information. Many people execute secondaries where the information they're dealing with is 3 to 6 months old. We're looking at situations where we're getting not only current information, but insights into the future. Now, by now with the pandemic, you have pretty good visibility into how and how much a business has been impacted thus far. And what we're actually more concerned with, believe it or not, are situations where a business has overperformed about a pandemic. And we want to make sure that we're scaling back some of the operational performance based on that overperformance. It's quite easy if a business has underperformed. Then it's directly impacted by the pandemic, and you're particularly cautious. But regardless, getting real-time access to information is critical.
Great. And also related to secondaries discounts, what did you see during the global financial crisis? Did discounts widen or narrow? And do you expect the same or different this time around?
Yeah, so both during the global financial crisis and today, discounts widened substantially. Now they widen, but on much less volume. The only people selling are the people that are in distress or really require liquidity. There was much more distress around the global financial crisis than there was today, or than there is today. We did have an opportunity to see some distress situations coming as early in the pandemic, but because the market corrected so quickly and because people were managing their portfolios more prudently, there wasn't as much distress as we were expecting in the first few weeks. But certainly pricing discounts did expand. They've tightened a little, but we still expect to see pretty good opportunities.
Understood. Fred, you have said that a number of companies benefited from COVID, and we've obviously heard a lot about Instacart, but can you possibly talk about some others as well as investments that you have specifically made because of COVID?
Sure. So another in our portfolio, Corey alluded to earlier, Unity Software is a good example. So they're the right way of thinking about this company is that they are the people who sell shovels to people looking for gold in the online gaming space. So if you want to build a game and you want to offer that game in the Apple ecosystem or the Google system or any of the other online ecosystems in terms of putting games onto apps, you essentially need your developers of those different games to have a license for the software from the Unity software. So it's a real stable company, stable revenue, high gross margin, a high moat and high barrier to entry. And it's probably no surprise to anyone, the COVID environment really accelerated some of the trends in that business because the demand for those types of products just exploded as people found their mobility and their normal experiences that they would consume, whether that be travel or vacation or other types of things, relatively constrained. That consumer dollar really shifted to the online world. That caused an acceleration of growth, kind of an explosion in the usage and the licensing from Unity, and then Unity was able to go public, during this year, and our current mark, it's a public company, but our current mark is, fivefold what we paid for it, a year and a half ago. So it's a good example of where you're a COVID beneficiary and it's really, really quite valuable. There are other types of investments that we were able to make where the companies themselves were relatively stressed, or there were opportunities to provide financing. So in credit, there was actually an example of one where we've been able to finance the mileage programs for some of the US airlines. And so United, American, some of the other core airlines in the United States are obviously under significant stress and pressure. One of their most valuable assets is their mileage program. They historically chose not to finance it or not to leverage it separately from the core business because it was so essential to what they're doing. But the COVID pandemic and the stress their businesses were feeling forced them to take the action of actually going and doing a financing around those subsidiaries. And we were able to provide in our credit sleeve for the vehicle to provide long duration financing around some of that. And all of those instruments priced with yields during the crisis that were sort of in double digits and then compressed to 6 or 7%, as the crisis abated. And so, and you could go on and on in the real estate space, in infrastructure, in other areas that we're participating in, what Brian's doing in the secondary market across all of these sectors. There's just a lot of opportunity because people's capital structures, even if they're prudent management, they had very solid franchises, good businesses, there are certain people who found their capital structures inappropriate for an environment where the revenues were depressed in a way that they didn't anticipate. Sort of got hit by a meteor. And so there were a lot of opportunities to provide capital to very good businesses that were feeling stress and distress, which is, obviously the ideal method of making stressed investing is to do it in companies that you would want to own for the long term, but they're experiencing something unforeseen. It wasn't bad management or some structural nature of their business, which was poor. It was an opportunity provided by an exogenous variable. And so that's why we're excited about those.
Great. You spoke about Unity being listed, PE1, private equity. Why have we held it, and does Grosvenor have a policy around holding companies through listings or holding listed entities?
Yeah, so it's a good question. So in that particular case, that was what we'll call a crossover investment. And so the business had emerged. It was a multi-billion-dollar business. We provided capital to accelerate the company's growth while it was a private enterprise. And the markets were relatively inefficient at that time. Kind of 1.5, 2 years ago, it was a relatively inefficient market, and we took advantage of that. The company then went public. We're traditionally subject to about a 6-month lockup when those companies do go public. And then when those lockups expire, we typically look to monetize those investments at that time. And so, which is very typical for most of the investors in the crossover space. And so, that's a good example, sort of cradle to grave, so to speak, for that investment for us, that you would see us go through that cycle. The only thing that's unique, typically we would expect to hold those from sort of a 3 to 4 years hold while they're private before they go public. It typically takes some time, but the events in the COVID pandemic provided the perfect opportunity for these particular company to actually accelerate that path and go public at what has obviously been a very good market for their securities.
Fred, you might just touch on how those are valued in the portfolio and that we at the moment or in the last value.
Yeah, so it's a good question. So typically what happens, and Corey, you can maybe talk about it a little bit too, because I think Corey spends a lot of time for us working with our valuation folks. While it's private, we tend to be very, very conservative. We take a sponsor mark, right? So it's not Grosvenor valuing the security. We're taking a sponsor's mark. We check it to make sure that it conforms to what we think are reasonable expectations. That typically is cost. And so Unity had been obviously experiencing significant accretion in its valuation over this period of time. But we held it at cost until such time as it went public. When it went public, we then take the sponsor mark still. The sponsor mark typically becomes the valuation you see in the public markets. They sometimes ascribe a discount depending upon the size or nature of their block. So for example, if we own half of the public company, there might be a discount associated with it, or even a premium if you have control. And so there are minor adjustments that the sponsor makes, but that's what we do. The timing of those marks, I think Corey might have just fallen off, but the timing of those marks, everyone should recognize, is in arrears. And so there's a process that we go through for the marking of our funds quarterly, and then those values are then published and put out in arrears in the in the quarterly marks and then the monthly marks associated with the vehicle. And so you would see those, and we use best of information, obviously, for the purposes of rolling up all the valuations in the trust. But the key principles are, we're not doing it, the sponsors are doing it to maintain independence. We do overlay checking on those valuations. And the valuations, appear with a slight lag. So if I quote a public security price, or you look up the public security price, obviously the trust is reporting monthly and quarterly, and so there's a slight lag in some of the vehicles in terms of when those are rolled up. I don't know, Corey, if there's anything you would want to add on how the valuation would roll up for Unity, for example.
Yeah, no, I think you covered it pretty well. I guess just on the lag point, I know Fred mentioned, we have our own process that we overlay. Our valuation committee actually was just meeting last week, I believe, or actually earlier this week, to start looking at valuations for our 9/30 numbers, right, which would come out sort of later in December. So it's just that lag piece. So they'd be looking back at what those valuations we received from the sponsors were back at 9/30, and utilizing that as a basis for coming to our conclusions, and then rolling it up into our vehicles.
Great, thank you. I had actually hoped to ask quite a few more questions because we still have a lot of unanswered questions, but the hour's up. So in the interest of time, I'm going to wind up now, and we will respond to all unanswered questions directly. Thank you very much to everybody who has joined us. I think that the additional perspective about the secondaries market was extremely relevant given the amount of capital from the recent raising that we are going to allocate to the sleeve. Hope you found this update interesting and valuable, and if you have any other questions, please get in touch with us. We'd love to hear from you. Thank you very much for joining, and enjoy the rest of your day.